Hey, everybody, welcome back to our weekly mortgage market update with our guest, Hammer J. Helmer, the man, the myth, the legend, the cowboy hat. Always got a lot to share and a lot to talk about. So, we're not going to prolong this much. I mean, honestly, it's good to be back. We were together last week at an event with Christine Beckwith in the Vision Summit, Vision Your Success event. It was good to talk in person after so long on these video calls. But, Hammer, we're back. What do you got for the people, sir?
Well, first things first, if we've ended up having to take a week off in between the last couple, so it's been every other week,
Sure.
and we should. This just creates so much good things to talk about. There's a lot to actually catch up on. But
Right.
if you do find that these calls help you, and especially when we during the summer, we travel and they may be a little more erratic. If you're not able to make them live, definitely let us know if you're watching on the replay. Just put a hashtag replay in the comments. Make sure any questions that you have about what's going on with rates or the
Mhm.
housing market, anything at all, even you can put them in this post. We'll be sure to answer them. It's why we do these things for y'all, is to help you guys to be educated and understand what's going on in the direction of rates and why it's happening and all that good
Yeah.
stuff. So keep that in mind for sure. And if you do get some value out of these, do us a favor, just share with us, put that hashtag replay in the comments, and that lets us know that you are getting value. And of course, if you're here live, you can say hashtag live or just ask some questions, and we'll know that you're here. So anyway, it has been a couple of weeks since the Fed has raised rates. And let's kind of roll back 2 weeks ago and talk about that Fed rate increase. So, the first thing is that everyone needs to realize that when the Fed raises rates, it does not directly raise mortgage rates that day when the Fed raises the rates. In other words, they're not changing mortgage rates. What they're adjusting is the Fed funds rate. We've talked about this before, but it's really important for anybody that might not have seen those to know that mortgage rates actually react weeks and sometimes even months in advance of these expected Fed rate hikes. So right now we've got a couple different opposing forces. We have inflation, which everybody is feeling at the pump, at the kitchen table, where everything's just gotten much more expensive. And inflation, you want a certain amount of inflation for a healthy economy. You want about 2% inflation. However, we've seen inflation upwards of 8%, and what that does, of course, is it drives the cost of everything up. It makes your ability to buy with what you were making yesterday. You're able to buy a lot less. Instead of my fancy, I'm traveling, so I had to get a fancy coffee. I like my good old regular coffee maker, but instead of a tall, I don't know what they call these, a grande. Instead of a grande, maybe that same couple bucks only buys you a tall. You're not able
Yeah.
to get the same amount
Right.
for your money. So the Fed, in order to try to curb inflation, the Fed is fighting inflation with a couple different things. One of which is they're actually pulling back from all the purchases they did in the bond market. So back when they were trying to get the economy going through the COVID pandemic, they were buying up bonds. They were buying treasuries. They were buying mortgage-backed securities. Those are the two that they buy. And the
Hmm.
mortgage-backed securities that they buy in the bond market are what help us to keep mortgage rates low for 2020, 2021. And that's why we saw these absolutely record, you guys heard record low rates so often, but they really truly were record low rates. And it was because of the Fed trying to keep the economy moving. Well, now the economy is moving, and it's moving like a freight train. And that's why inflation has gone up. There's a lot of demand, there's not a lot of supply. So
Right.
now the Fed is trying to slow everything back down. And instead of buying up all these bonds, they're actually now selling off some of the bonds that they've already bought, and they're adding more supply into the market, which is reducing, and meeting that demand, which is going to drive your mortgage rates up a little bit higher. And we've seen that in 2022. We've seen rates go from the twos to the threes to the fours to the fives, and even for some people touched into the sixes a couple of weeks ago with some inflation data that came out that spooked the markets. So couple weeks ago, Nathan and I were on this call, and we were talking about how things had looked like they were going to stay pretty good, and then all of a sudden things got crazy and rates went up, and people were like, "Hammer, what's going on? I thought rates were stabilizing. You've been saying they were
Right.
stabilizing,"
Right.
and I said, "Well, they still will. They still will. Unfortunately, we had." A very emotional time in the market. Markets can be very emotional. Consumer sentiment
Hmm.
is one thing, and investor sentiment is another. In other words, the people buying all this stuff, they start to get into they get into that lemming mode where they see everyone else doing it and they start doing it and they're afraid they're going to miss out. They're afraid they're going to lose out, and it kind of creates a landslide. And that's what we saw happen. So mortgage rates shot up to rates we haven't seen since 2008. Now, Nathan, you guys keep a tremendous amount of analytics with vetted VA. I have definitely noticed that there's veteran rates, VA rates for VA mortgages, VA home loans, and then there's the conventional rates for most consumers that are getting a Fannie Mae or a Freddie Mac secured loan. And the conventional rates were up in the sixes, but a lot of the VA rates still stayed in the fives during that time. Did you notice anything similar to that? I know I'm putting you on the spot.
Absolutely.
I don't know if you guys
I mean, the guarantee
that.
on the guarantee on the VA loan makes it a better bet in many ways. It's less risky, and so they look at there's a lot more level setting with multiple pressures, not just market pressure. There's a different pressure set.
Yeah, and I don't talk about that often. So it's important for any of you guys watching this, any of y'all, I say guys, that's a term of everybody. Any of y'all watching, that everyone realize that if you have the ability to get a VA loan, and even though there are some challenges to it, and there's lots of professionals here that can help you to overcome those challenges, finding the right people to work with, but you can save a lot of money by using your benefit, your VA benefit, and getting a VA loan, because those rates are generally going to be a little bit better than the normal conventional mortgage rates that you're seeing. And again, it depends on your credit score and your purchase price and your area. There's a lot of variables that go into a mortgage rate, but you will find that there is an additional benefit to make sure that you are using your entitlement and that you guys are using the benefits that you've worked so hard for. So anyway, so now that was a couple weeks ago, we saw rates go up to this really high level. Now they started to come back down again, and we're back where we were about a month ago. Not the lowest rates we've seen in 2022 by any means, but I've heard some VA loans getting into the fours. Not sure if anyone's got any loans locking in the fours right now, but I did hear a couple, but a lot of them are going to be in the fives, but they're going to be in the low to mid fives, and that's kind of a great spot to settle in. Anybody that's looking to buy a home now, you want to consider the fact that you will have an opportunity, most likely later this year or early next year, you could see rates come down, and you don't want to wait to buy until rates go down, because right now we're starting to see a little bit of a level. If you guys watch my hand, I'm doing a little seesaw action here. And what happens generally is on one side of the seesaw, you have rates, and on the other side, you have home prices. And as the rates go up, home prices start to go down. We're not seeing home prices go down per se, but what is happening is they're not going up as quickly as they were. And that's about all we can ask for at this point, because there's a lot of demand. There's not enough homes out there, and that's not something that's going to change overnight. So rates have gone up and demand has slowed down. So the home prices are starting to kind of level off. And if you wait for rates to drop, that's going to create more demand. Home prices could, and we don't know the future, but it's very likely they could start to increase in speed again. We could see prices go up a little bit quicker, a little bit faster. So this is still a great time to get out there looking to buy a home for sure. And if rates go down, then we introduce you to Earl. And Nathan, this is always your cue. Tell them about Earl.
I know. I love the Earl, right? So if you're in VA, you get the interest rate reduction refinance loan, drop yourself a half point or more and control all those fees in that structure. It's fantastic. It's unlike other refi opportunities, this doesn't necessarily reset your lending margin so high that you lose the ground you made up in your payment. And that's a beautiful piece. We want to maintain that.
Very much. And I think they have to be in the loan for about 6 months on average. There's an actual
210 days from the first day of payment. So a little over 6 months. It's roughly 7.5 months or so.
Yeah. So any of you that are buying a home now, if we do see the recession that a lot of people are calling for, that think is, already happening, starting to happen, then you're going to see, if those rates go down, you'll be in an opportunity to save yourself some money then. So keep that in mind.
It's the caution of that. Don't buy down the rate, right? Like at this point, save the cash, keep the money, hang tight.
Very good point.
Don't worry about buying down that rate.
There's a question in the comments, Nathan. How many times can an Earl be done?
Yeah. The correct answer is unlimited on the same property. It's just the timeline is what usually catches people off guard, and the interest rates. You can't do an Earl if you're not saving a certain percentage on the rate moving forward, and the cost benefit analysis has to balance. So there is a point where you just don't do them anymore. Anybody who locked in about a year ago in the 2.25, you're gonna be hard pressed to do an Earl
to do anything. Yeah.
maybe ever. It's just gonna be that's gonna be a tough one. Sounds like
Sorry,
you
a
got
little
some
San
excitement out
Diego,
there in
yes,
San Diego,
San
right?
Diego wildlife going on. Sorry.
We should probably not tell
Um,
everybody where you're at, because then all the Navy guys will come over and try to ask you questions.
Yeah, I saw a lot. I'll tell you, it's amazing the amount of naval ships I saw. I took a dinner cruise yesterday, some cool stuff. But and that's Nathan. That was a great thing that you talked about too. That a lot of people don't realize when we talk about the Earl or any refinance, there is a requirement that you have a net tangible benefit. In other words,
Yep.
the government, in order to back that loan, they require in the guidelines that the mortgage company prove that you're benefiting from this refinance. And that sounds silly. You're like, hey, come on, I can make decisions. I'm a big person. And but there's a lot of things that we can do inside of the numbers that can be a little underhanded and confusing. And that's not confusing because of somebody's anything more than maybe inexperience, right? So
Right.
it is important to note that there is a net tangible benefit requirement. We have to prove that you're going to benefit from that refinance, and but the point being that where we'll probably see rates go, there's a very good chance, and I don't have a crystal ball, but there's a very good chance that we're going to move in that direction where you will see enough net tangible benefit, and you'll be able to do those Earls, and you'll see a significant payment reduction. So it definitely is still a great time to consider that. But as far as anybody that maybe you're under contract now and you say, okay, Hammer, when should we start to look at locking in rates? Anything right now, we're probably in a little bit of a capped out area. In other words, I'm going to show the screen for a minute, Nathan, if you don't mind. Let me click on screen share, and I'm going to share the screen with everybody. And this will be a little confusing. We'll walk you all through this. So
while you're doing that, I just put in the comments on the main group, and I'll drop them everywhere. But the interest rate, the Earl, the refis, that's chapter 6 of the handbook. And if you're wondering, like, what are the ins and outs? There are some caveats, as always, how much we can do. But it looks like the screen looks good.
Yep, just go ahead and whenever you're ready, pop that on. And I can't see you because I'm on the portable computer today, so I only have one screen. So everybody, what I wanted to show you here, these are unfortunately this little box pops up and gets in the way of my mouse, but I want to show you all these fancy little lines. These are called Japanese candlesticks, and these are what we use to monitor what's going on in the back end of the mortgage market. And as we've talked before, mortgage rates are really, if I were to oversimplify, I would say they're two things. They are the price that mortgage bonds are selling for on the back end, and then they are the margin that your lender needs in order to make a profitable business on the front end. And that's why we always tell you to shop around. So right now, what you'll see though is we look for the patterns in this, and the higher these candlesticks go, that means that mortgage bonds are selling at a premium. They're worth more money, and that means your mortgage rates are going to improve. That's the very simple relationship. And as these go down, we can see here as they go down, that means your mortgage rates are going to get worse. And this giant red candlestick right here on June 10th, this was the day. I feel like I'm singing that American Pie song. This was the day that a lot of the mortgage people died. This was the day that we all saw a lot of fears of inflation. There was some inflation data that came out and it shook up the markets. And then you could see the following couple of days, you can see just how severely these candlesticks drop and they go lower and lower. And that's why mortgage rates jumped up. Like we said, some people even saw rates in the 6s. And then what we've seen though is as they turn around and you see this chart go up, the direction of these candlesticks go up, that's where you've seen things improve again. And they're settling back in. So, but what you'll notice is we're fighting this red line right here. We look at some what we call technical indicators. So investors, when they're deciding when it's a good time to jump in and buy these or sell these, they're also looking at these same technical indicators. And that's why we look at it. And when investors right now, they're saying, okay, we've seen bonds improve in price, and I don't really want to buy beyond this. So think about the idea of buying stocks, right? If you wanted to buy low and sell high, that's how you make money. If you buy high and sell low, you lose money. And bonds are the same thing for traders and investors. So when they see the bonds are going up to a certain price and they say, okay, that's about all I'm willing to pay. and I'm going to wait for them to come down a little bit before I buy more to put in my portfolio. And that's why we see these ups and down movements. And right now we're kind of at the peak of an up movement. So it looks like we're very ready to see a downward movement. So if you've got a loan that you've been floating and you're closing soon, you want to talk to your mortgage professional because it depends on your unique situation. But I would consider locking in loans that are closing, and that nearer term in the next couple of weeks, because, even maybe through the end of July, because it looks like we're in a really good spot. We've seen rates recover quite a bit from those really heavy levels that we saw after that inflation data on June 10th, and then the following week on the 13th and 14th, we saw some really, really bad rates. And we've seen a lot of recovery since then.
Yep.
So for those of you that are looking and say, hey, when's a good time if I were trying to time the market? Well, remember, timing the market is very difficult, and it is a little bit risky, and you only know that you've done it well when you look back on it. So, but looking forward, I would say that now is a great time to consider locking in some rates. I don't think that you'll end up in trouble if you do. We might see some minor improvement, but I don't think we're going to see significant improvement. You're not going to see that if you lock in an interest rate soon, that rates are going to drop by 0.5% or a whole percent. I don't think that that's very likely. There's nothing going on in the markets. What's causing this improvement is fear of recession. So at the beginning of the call, I was kind of talking about the two things that are driving the markets. There's actually fear of inflation versus fear of recession, and fear of recession is bigger than fear of inflation right now. And we've seen some data that has come out and said, hey, things are looking good now. It is 12:18 Eastern right now, and Nathan, you can put back to my face, and we'll go back to stop the screen share. Thank you. So it's 12:18 Eastern right now. At 2 p.m. Eastern, there's going to be a release of the Fed meeting minutes. Their minutes from their last meeting when they came out and they raised the Fed funds rate by 0.75 of a point. We already talked about that's not what raised mortgage rates. Rates have gone up before that on the expectation that the Fed was going to have to take a very strong stance and be very aggressive to fight inflation. And it looked like the Fed kind of got cornered and bullied into taking that stance. We expected to see the Fed raise their Fed funds rate by 0.5%. Instead, it was by 0.75%. Today, we're going to get the minutes from that meeting where they made that decision. And everybody is looking to see, okay, how likely is it at the meeting at the end of July? Are we going to see a 0.5% rate increase or a 0.75% rate increase again? And that's kind of what they're vacillating between. And a lot of the markets are pricing in a 0.75% rate hike right now. So if there is in the meeting minutes, in those comments, if it's a belief that we will see that 0.75 point rate hike, things will probably stay the same. They could get a little bit worse even. If there was a belief that we would see a 0.5% rate hike, that the Fed would not have to be as aggressive, we wouldn't wait until July to see that result. We would actually see that speculation have an effect on your mortgage rates today. We might see a little bit of improvement. When I say a little, I mean a little. You might see some better pricing, and your closing costs might be a little bit better, or you may see 0.1% in interest rate, but you're not going to see a dramatic improvement in rates. So, and over the next few weeks, we should see rates, they're going to move up, they're going to move down a little bit, but probably by about 0.25% higher, 0.25% lower. That's our range. And you shouldn't see anything get too crazy, because the expectation of recession is there. And the idea that, excuse me, that the Fed is, all of these activities are slowing down and isolating and now eliminating some of that inflation. As long as markets believe that and investors believe that, mortgage rates will stay steady. If there's a fear that inflation is going to increase, then we'll see mortgage rates react to that negatively. We would see rates go a little bit higher. So, but right now it looks like we should see, pretty standard. And that's it. There's a question: are there any false narratives veterans should be cautious of?
Yes.
Nathan, do you know how to answer that one? I'm trying to place where we would.
A little bit. Actually, this came up a couple days ago. Here's a couple of false narratives. Anybody trying to push you right now to do a cash out refi to pull the equity of your property, don't just jump on it until you actually talk to somebody to counsel you through the ins, outs, and the hurts of what that could look like. There are opportunities right now, even in a higher interest rate market, where cash out refi might be in your best benefit.
Yeah.
Here's one of the things they're using in those mailers, though. They're throwing out a rate, and they're looking at an adjustable rate mortgage on a VA arm, like a 5-1 or a 3-1, even a 10-1, right? And they're saying, hey, look,
what that means, those numbers, by the way, explain those numbers on a 5 or a 3.
I want to walk that in. Yeah. So
okay.
they may say, hey, look at this 4.5%. We can get you on your VA refi cash out at, and in the small print, you find out it's a 10-1 arm. What that means is that the interest rate is good for the first 10 years, and then it adjusts every year annually after that. Now, that could be good depending on what you're going to doing and your financial stability and your ability to manage and kind of forecast your finances and where you think numbers are going to be. A 3-1 arm, that means for 3 years that interest rate is fixed, but then on the anniversary and every annual anniversary after, it adjusts to the current market. And it uses different calculations and adjustment. It's not the LIBOR anymore, right? It's the
no. I don't know what the arms are going off of these days, most of them.
I'm blanking on it. The LIBOR was the old one. It's something else. And so they adjust and they recast your payment every year. Now, I'm just saying, be very cautious right now for this question. False narratives. Be cautious of too good to be true interest rates. Those mailers they're trying to churn money by doing refis. I just want you to be, now it might make sense, but please get a second opinion. Please run the numbers through somebody that you can physically or like look at on a video camera at minimum, and just say, hey, what does this look like for me? How does that impact me? That was one of the biggest false narratives I see right now. The other one is, I'm not going to call it a false narrative. I call it a cautious narrative, that the market's going to crash and just hang tight till the market crashes.
That's a bad
markets are like they breathe. If you look at your chest and you breathe in, your chest expands, right? At any time, a market will expand, but there's a point where it must stop, stall, and even start to exhale a little bit, right? And it kind of pulls back in, but it rarely ever goes back to or less than its original space. It usually expands. Maybe I should do it this way, since we're not three-dimensional space right now. It expands and then it comes back, but then it expands and it comes back, but not all the way back. 2008 was remarkably an amazing time to live.
2008 was very different because it was caused by
so many other market
lending money to people that couldn't pay back the money. That was the oversimplified version. We're not facing that today. In fact, all of us are just scratching our head because it's been over a decade now that we've been lending money with very strict guidelines, and the number of people that qualify are still there. There's quite frankly, people, there's more asses than seats.
Qualified mortgages, ability to repay. The regulatory oversight that we have to go through in lending money is so much higher than it was in 2008. If it makes sense for you and your plan, it's a good time to move forward. If it doesn't, don't wait. Prices aren't going back to 2019 or earlier. We're not going back there. Like, for all intents and purposes, if I'm wrong, I'm so sorry. I'll apologize then, but I'm feeling pretty solid on this one. So that's another one that I would say it's a cautious tale. And when I get stressed, I have this awesome squishy ball now of Hammer's Originator Success.
Does it look like me? There you go.
Kind of. You need the mustache. But those are the two things I'd say now. Y'all, this group is open. We want to hear your questions. Please make sure you ask those questions. Everything is circumstantial and case by case.
Yeah.
Yeah.
It always says that, but that's because we want to keep it open. But for generalities, it's still a great time to buy a home. I'm encouraging my kids to buy houses right now, because if you want to make generational wealth, the way to do that, I wish if this is where Christopher would really jump on that soapbox there and tell you guys, the way to do that is with a home, especially if we are going into a negative time for the economy and there is a recession. Buying a home is a great insulator for that. And I mean, it's more than just, hey, I want to put pictures where I want to put them. I want to paint walls when I want to paint them. There's a lot of freedom that comes with owning a home that you don't get from renting. But there's, financially, there is a huge windfall in this country to owning a home. And I think it's becoming even more, quite honestly. I think there was a time years ago or decades ago that owning a home helped you get wealthy. But I think that it's even more of an important part of today's, financial picture. So it's a great time.
And I'll tell you this, anybody watching, go pick this book up. This is the type of point where you're like, I need to read. If you're interested in real estate markets, pick this book up and read it and think about it. And read it 3 or 4 times in a row. Where you buy a home
gonna pick-
is going to be as important.
I'm going to pick that one up because I like to look at the byline. Let me see the tagline, the byline again. It was how to find a profit from up and coming areas, and that's the conversation that I've had with my kids is about buying in the right place where
Yes.
Terms like gentrification get used, and I think a lot of times they get falsely used. Anytime a place goes
They
from
do.
lower worth to a higher worth, it gets there's things thrown around, but there's a lot of places that you could buy in this country right now. I know there's a lot of spots that are unaffordable. I'm in California, and I was looking at the just the ridiculous prices according to me, because I'm from a different part of the country, and
Right.
my house here is a $2.5 million house, whereas by me it's a $800,000 house, and you put it in
Right.
somewhere else and it's a $300,000 house. So
Yep.
definitely where you buy can be as important as what you buy.
Oh, it's so good. All right. We've had our time. We're going a little long.
Long
Hammer,
time today.
enjoy your vacation, man. To everybody else, put your comments down below. We'll be tracking on this. Give us a hashtag replay if you made it all the way to the end, and we'll be back next week with some more information as it comes to us.
Sounds good, my friend.
All right. Take care,
Take care,
everybody.
everybody.